welcome to the deep dive. Today, we're taking a really close look at Bausch Health's Q3 2025 earnings call.
Right.
But we're going to be pretty specific. We're filtering out almost everything except for the financial strategy. So we're really just zeroing in on the narrative from the chief financial officer. You know, the numbers, the drivers, what's actually moving the needle.
That's absolutely right. I mean, our mission here is to take those dense, pretty technical remarks and just translate them
Into something we can all use.
Exactly. We want to distill the operational side, the key growth drivers in each segment, and maybe most importantly, the strategic moves that let them raise their full year guidance.
We're looking for the why, the story behind the spreadsheet.
The why, precisely.
And before we even get into the Q3 numbers, we have to set the scene with, I think, the most important piece of context the CFO gave.
Oh, yeah. The streak.
The streak. This quarter marks the 10th consecutive quarter of year-over-year growth for the core business, Bausch Health without Bausch plus Lomb.
And that is not an accident. I mean, in the pharma world, 10 straight quarters of growth like that, it just signals this deep, disciplined operational health.
Especially now.
Especially now, yeah. With inflation, supply chain headaches, softness in some big international markets, it suggests their core portfolio is incredibly resilient.
Okay, so let's unpack that resilience. Starting with the big picture, the consolidated non-GAAP figures.
Yeah.
What did the whole BHC ecosystem look like in Q3?
Consolidated revenue was very strong, came in at $2.681 billion.
Okay.
That's a really robust 7% increase reported, which is about 5% organic growth year over year.
And EBITDA?
Adjusted EBITDA for the entire company followed right along, hit $986 million. That's up $77 million, or an 8% jump from last year.
So that's healthy on the surface. But when you look a little deeper, I noticed the margins tightened a bit and the cash flow looked a little slow for the whole operation.
Exactly. That's the catch. The adjusted gross margin was 72.67%, which is a 40 basis point dip.
So cost of goods or something.
Could be. Some kind of pressure in the system. And here's the real kicker for the consolidated business. Adjusted operating cash flow was only $58 million.
Wait, $58 million on almost $1 billion in EBITDA. That feels really muted.
It is. It's quite muted.
Right. And I think that brings us to where the CFO really spent his time. BHC, excluding Bausch plus Lomb, this is the core engine, the part that's on that 10-quarter streak.
This is where the story is. So focusing on that core business, the financials show really excellent traction. Revenue hit $1.4 billion.
That's also up.
Also up. 7% reported and 5% organic. And adjusted EBITDA for this core segment was $773 million, a solid 7% increase.
Okay, now here's where we have to dig past the headline number, because that $773 million in EBITDA, it had a huge charge in it that kind of made the performance look weaker than it was. What was that?
That was an $81 million charge, and it's related to their acquisition of a company called Direct.
Okay.
The accounting term for it is in-process R&D, and this is really, really crucial to understanding the quarter.
Explain that. What is in-process R&D?
So when a company buys assets or products that are still in development, not making money yet, accounting rules require them to take a charge. They essentially have to expense the value of that unfinished research right away.
So it's a non-cash accounting thing.
Exactly. It's not about operational performance.
So if we just sort of pull that $81 million accounting requirement out, how fast was the core engine actually moving?
If you exclude that charge, the operational adjusted EBITDA for the core business increased an outstanding 18% year over year.
18%.
18%. It's a massive signal of just how much their underlying profitability has improved.
Wow, okay. An 18% operational jump is really impressive, but we have to connect that back to cash flow. If the business is running 18% hotter, why was the cash flow for the core segment only up 1%? It was, what, $347 million?
Yeah, where's the disconnect, right?
Exactly.
And this brings us back to that phrase you always hear, working capital timing.
Yeah.
It just means cash flow can lag when a company, say, strategically builds up inventory, or if they have really strong sales late in the quarter.
So they have a lot of accounts receivable.
Precisely. They've sold the product, they've booked the profit, but the customer hasn't paid the bill yet.
So the CFO is basically saying, look, the cash isn't in the bank yet, but it's coming in Q4. It's a timing thing, not a profit thing.
It is, and that context is vital. Now, if that cash doesn't show up soon, then you'll start to hear questions about the quality of that 18% EBITDA. But for now, it's a timing story.
Okay, that makes sense. Let's move into the segments then. Starting with Salix, their big gastroenterology business that's always a powerhouse. What drove it this quarter?
Salix really delivered. Revenues were $716 million. That's a 12% reported and 11% organic jump year over year.
Huge.
And this phenomenal quarter was driven by two key factors. We need to look at both, because one is sustainable success and the other is more of a one-time strategic lift.
Okay, let's start with the sustainable part. Xifaxan.
Right. Xifaxan revenue grew 16% year over year, and the actual volume of prescriptions was up 9%.
That's strong.
What's genuinely remarkable, though, is how they're doing it. They're using an AI-driven customer insights engine.
Oh, interesting.
And that tech led to 9% overall script growth and, get this, 11% new patient script growth.
Wait, 11% new patient growth for Xifaxan? For the OE indication. Isn't that drug like 15 years old?
It is. It completely defies the typical life cycle curve for a mature drug.
So what is this AI actually doing?
It's precision marketing. Instead of these broad campaigns, the AI is likely targeting very specific doctors who see the right patients but haven't adopted the drug yet. Or it's finding patients who've lapsed their treatment. It's surgical.
Generating fresh demand for an old asset. That's the sustainable part. Now, what about that strategic lift? The one-time net pricing favorability.
Right. That sounds like jargon, doesn't it?
It does. Break that down for us. What happened when they exited the Medicaid and 340B channels?
Okay, so this is a bit complex, but it's crucial. 340B and Medicaid are government programs that force drug companies to offer huge discounts, mandatory rebates.
Okay.
When Bausch decided to just exit those channels, they got to immediately reverse all the money they had set aside to pay those future rebates.
You mean for past sales?
Exactly.
Yeah.
For all the sales where they'd legally accrued money expecting to pay a big rebate, suddenly, poof, they don't have to pay it anymore. That reversal flows right to the top line.
Wow. So it's an instant boost to net revenue.
An immediate quantifiable benefit. They basically traded access to those discount programs for much better pricing right now.
So Salix's amazing 12% growth is a mix of real AI-driven horsepower plus this massive one-time financial move. Fascinating. Let's switch gears. How did the international segment do?
International was mixed. It faced some tough headwinds. Revenues were $286 million, which is down 2% reported, 4% organically.
A real story of different geographies, I take it.
Very much so. Europe, the Middle East, and Africa, the EMA region, that was the bright spot. It was up a strong 12%.
But that was overshadowed.
Completely overshadowed by softness in Canada, which was down 8%, and LATAM, which was down a worrying 17%.
Okay, let's look at that drag. Canada's minus 8% seems bad, but the CFO mentioned a non-recurrence thing, right? A tough comparison.
He did, yeah. This is another one of those difficult comps. Canada's core promoted brands actually grew 21%.
So what was the problem?
The problem was their all-other portfolio. In Q3 of last year, that portfolio got a huge temporary boost because competitors for the drug Wellbutrin had stockouts.
Ah, so Bausch filled the gap.
They filled the gap, got a one-time windfall in 2024, and now in 2025, the comparison looks artificially bad. LATAM, though, is a simpler story, just real market softness, particularly in Mexico.
Got it. Okay, moving on to Solta Medical, their aesthetics business. This is always the volatile one, the one with explosive growth potential.
And it absolutely delivered on that top-line growth. Solta revenue was $140 million. That's up an impressive 25% reported.
And it's all about Asia, right?
Overwhelmingly. The Asia-Pacific, or APAC region, now makes up about 80% of global Solta revenue.
And the most astonishing number in the whole transcript for me was South Korea.
It's breathtaking, isn't it? South Korea showed 96% growth year over year.
96%. They basically doubled the business in a year.
In one major market, yeah, it's fueled by domestic demand and a big return of medical tourism.
You can't sustain 96% growth, obviously, but wow. However, APAC is usually dominated by China, and that market was pretty cautious, wasn't it?
It was. China only grew 3%. The CFO said it's because aesthetics consumers there are just being cautious with their money because of the macro uncertainty.
It's a very sensitive barometer for consumer spending.
Is.
But that slower growth in China really highlights why they're trying to diversify. Right? Did that work in other markets?
It did. They saw encouraging double-digit growth in the U.S., and EMA, and in Canada, so those commercial investments they've been making are starting to pay off and reduce their reliance on just the APAC engine.
Okay, finally, before we get to the guidance, a quick look at the diversified segments.
Right. Diversified brought in $258 million in revenue. That was down 4% reported, 6% organically. And it's a similar story to Canada, actually.
Another tough comparison.
Another tough comparison, this time in the neurology business. It was due to the non-recurrence of orders for a drug called Carsol.
A generic supplier shortage last year.
Exactly. Revenue was unusually high in Q3 of last year, so this year the comparison just makes the whole segment look weaker, even though parts of it were on fire.
And the dermatology part of it was on fire, right? 2 products in particular.
Oh, yeah. Dermatology showed serious muscle. Capture revenue was up a staggering 186%.
Wow.
And Jublia, another key product, grew 11%. So even though the headline for the segment was down, the products they're actually promoting are clearly working.
Okay, so let's recap. We have strong overall execution, Salix growth driven by AI, Solta's amazing APAC story, and this improving operational leverage. It all led to a big raise in the full-year guidance.
It had to. The performance through 9 months was just too strong to ignore.
So what are the new numbers for the core BHC XB plus L business?
The revised guidance for 2025 really shows management's confidence, especially in profitability and cash.
Let's start with revenue.
Revenue is now expected between $5.0 and $5.1 billion. They raised the midpoint by $25 million, which is about a 4% increase year over year. Solid.
Okay. And for that key operational profit metric, adjusted EBITDA.
Adjusted EBITDA is now expected between $2.7 and $2.75 billion. Here, the midpoint went up by a much larger $50 million.
So profit is growing faster than sales.
That's margin expansion. It translates to a 7% increase versus what they expected for 2024.
That is the definition of operational leverage. And what about the big one, the cash flow goal? That's where they really boosted the numbers, wasn't it?
Absolutely. Adjusted operating cash flow is now expected to be between $975 million and $1.025 billion. They raised the midpoint by a massive $150 million.
So that's management saying, we know Q3 cash was slow, but we're going to make it all up and then some in Q4.
It's a huge statement of confidence in their Q4 cash conversion.
And despite this big guidance raise, the CFO was very clear that their 3 core financial priorities haven't changed at all. Let's just run through those quickly.
Sure. The first pillar is simple: increasing asset value. That just means keep doing what you're doing, execute on growth, innovate. The Salix performance and the direct acquisition are perfect examples.
Right. Buy new assets, maximize old ones. Priority 2 is unlocking value. What does that really mean for them right now?
Unlocking value is all about evaluating options for stakeholders. And it's tied directly to that huge $7.9 billion refinancing they did earlier this year.
That gave them expanded optionality.
Exactly. It pushed out their debt deadlines, giving them breathing room. They're not scrambling anymore.
So they can be strategic?
They can be strategic. They can look at asset sales, restructuring, whatever, to maximize value without having creditors breathing down their necks.
So the refinancing bought them time and choice. And the third priority is just that relentless focus on the balance sheet.
That's right. Priority 3 is optimizing capital structure. And they're still executing. They retired over $600 million in notes this quarter. They got rid of a high-cost receivables facility. It's just a constant process of cleaning up the balance sheet while funding growth.
So this deep dive really showed the complexity behind their Q3 success. I mean, it wasn't just simple organic growth. It was AI, it was APAC dominance, and it was this really clever financial move to exit those government channels.
And that's the thing I think we should leave you, the listener, to ponder. That immediate, huge benefit they got from exiting the 340B and Medicaid channels, it gave a massive lift to Q3.
But there's a cost.
There's a strategic cost. Those channels serve millions of patients. So the big question going forward is, how do you manage sustained growth when you've just walked away from major market access points?
Their strategy has to change.
It has to pivot entirely to operational efficiency, premium pricing, and making sure new assets like Direct start generating high-margin revenue immediately to make up for that lost access.
It's a classic trade-off, isn't it? Short-term financial gain for long-term market breadth. A fascinating strategy to watch. Thank you for joining us for this deep dive.